So today we are doing specific investment decisions. What are we going to do under this? What are specific investment decisions? Specific is like you general investment decisions like are nothing but we want to invest in a project and we want to check whether that project is going to give us uh, or, or going to create value for us or maximize our wealth in the future or not. We are going to check that. In case of specific investment decisions, you are looking at specifically some investment option and then whether that investment option is going to create value for you, create wealth for you or not, you're looking at. So for instance, here your agenda is to look at a specific thing, asset. You want to replace your asset. The aim is to replace the asset. Here, however, you're going to replace your asset because you have made up your mind to replace it. If you don't replace it, the asset is going to create more, or it's going to be more expensive for you if you're going to use it prolonged. How? See, let's say I bought an asset and its life is 5 years. I need to replace the asset after this, or like I need to replace the asset in this timeline. If I don't replace within 5 years, then in the sixth year, it's going to increase my expenses. It's going to become more expensive for me. Repairs and maintenance, servicing cost, and its efficiency is going to decrease, and it's going to become obsolete, and it's not going to give that kind of service or output what it was giving previously. So it becomes advisable and wise to replace the asset. But on what basis I need to replace the asset? I need to see that also, right? There are two methods I have to employ for this. These two methods I have to use to understand whether I shall replace the asset uh, after certain years or not. Okay, not is not there here. You have to replace it. What is the ideal time to replace the asset? We are going to check with the help of these two methods. Then you consider to lease an asset or buy an asset. Let's say you want to buy an asset, you have made up your mind that you are looking to buy an asset to run your business. But there is an alternative to buy. You can also lease the asset and run your business. Out of these two options, which one is a better one and which is more value creating one and which is less expensive, you need to check. And for that, you have an PV method. Then capital rationing during the times of, during the times or periods when you lack money or you want to keep yourself restricted. There are two types of capital rationing: hard capital rationing, soft capital rationing. One is when your management is not allowing you to go beyond certain limitations. Maybe they don't want to take higher risk. They don't want you to go beyond $1 million for a project, even though your vision is something else. That means you want a higher investment project than this, but they will put a cap that you can't go beyond this limits. Maybe the company's managers have studied the risk appetite of the company. Their capacity is more, but their risk appetite, that means they want to take less risk. Okay, that can be one of the reason, and one of the reasons is you are ready to you want funds from the market and market is not giving the funds to you, required funds to you. Maybe there can be a number of reasons for that. Market is not good, market is not, you know uh, very bullish about investments. Recession is going on right now. There can be various things. Okay, so this is again one of the topics we're going to study in this chapter. And one more thing, when you have shortage of funds, you would now think very wisely to invest your money. You will be investing your money in parts, and sometimes you may take combination of projects. And for these two also, how to decide on what parameters you will decide the projects, we will see. First is asset replacement decision. Excuse me. asset replacement decisions, asset replacement cycle. So discounted cash flow techniques can be useful. That means you're again using the discounted cash flow technique. Why we use discounted cash flow technique? We do time value adjustments. Can be useful in replacing the asset or decisions related to asset replacement to assess how frequently a non-current asset that is in continual use in a business. Let's say you have delivery vehicles. You want to replace the old vehicles with new vehicles, but you're not able to decide, not able to you know get an idea what is the ideal time to replace it. That means shall it be replaced after 4 years, shall it be replaced after 5 years? That we can definitely know when we shall replace this. There are certain methods which will help or make our task easier to understand what is the ideal time to replace them. So if an asset is replaced less frequently, then it has a longer replacement cycle. Let's say if you are replacing an asset in 3 years, every 3 years you replace, more frequent. Every 5 years you replace, less frequent, longer replacement cycle. The length of the time between an asset being purchased and the asset being replaced, longer replacement cycle. Now, shorter replacement cycle, longer replacement cycle, shorter, lower operating cost. That means if your replacement cycle is for less period of time, your repair, maintenance, and maintaining that, or you're also using that asset, your operating cost will be less. If you're operating the asset, then definitely you have to incur cost on that. If you're operating for 5 years, every year, let's say your operating cost is $10,000. If you're using it for 5 years or your replacement cycle is 5 years, $50,000 is your operating cost. If you are replacing that within 3 years, $30,000 is your replacement cost. So it very clearly you can understand. Sorry, if at all, $10,000 is the operating cost of the asset per year you have estimated. If your replacement cycle is long, if you are using it for 5 years, your operating cost will be $50,000. Here, if you are replacing in 3 years, let's say replacement cycle, your operating cost is $30,000. $30,000 is definitely less than $50,000. The more time you use, the more operating cost. A higher residual value when the asset is disposed of. Yeah, here in 3 years, you can get more value for asset because less depreciation. In three, it's here 3 years depreciation happen. Here 5 years depreciation happen. But increased capital expenditure as the asset is being bought more frequently. Here you will be, always ready with your investments in 3 years time. Here in 5 years time. So 2 years, your investments are happening every 3 years. That means you have to arrange or keep the money with yourself ready every 3 years. So let's say here if it's like 3 or 6 years. So here let's say every 3 years you have to have capital. Every 6 years you have to have capital. That means if you take 6 years into consideration, 2 times the time is more and the capital is 2 times less. That means if you have to arrange capital here for every 3 years, 1 lakh, and here 1 lakh up every 6 years. So what are you saying here? So here 2 times, you are saying that 2 times less. Okay. Every 3 years, if I have to arrange 1 lakh capital, every 6 years, I have to arrange 1 lakh capital. In 6 years span of time, if I take this as my cycle, I want 2 lakhs. That means 2 times more I'm going to spend. Everyone, yes or no? If your replacement cycle is shorter, 3 years, and you always want 1 lakh capital every 3 years, so in 6 years you will be wanting 2 lakhs. But if 6 years replacement cycle, you will be wanting only 1 lakh. That's what. Everything which you have discussed here, the opposite is here. Reduced capital expenditure we discussed here, only 1 lakh in 6 years. Here in if your replacement cycle is 3 years, so every 6 years 2 lakhs. But as the asset gets older, it may cost more to operate, and the residual value will be lower. That's what more usage of asset for a prolonged period of time. If you are using it for 6 years, 7 years, your operating cost may be very high. and the scrap value will be very less. Now, here the decision is to replace. We will definitely replace. No other alternative. Because we have made up our mind or we want to replace here. The ideal replacement cycle will minimize the cost per year over the replacement cycle. What did they say? What is the ideal replacement cycle? The ideal replacement cycle is that cycle which, if you replace your asset at that moment, okay, or in that cycle, it will minimize the cost per year over the replacement. Why? Because if you don't replace at that point of time, or replace later, maybe after that your cost may increase, repairs cost, maintenance cost, operating cost, like the scrap, the residual value will be less. Okay, so the ideal replacement cycle will minimize cost per year over the replacement cycle. So if you replace at the ideal replacement cycle, that is better for your business, or better from the perspective of asset replacement. Why? Because if you don't replace that at that point of time, later on, if it is prolonged, or later on you're using it again for more prolonged period, the cost will increase. It will give it, the repair cost will increase, the maintenance cost will increase, the service cost will increase, the fuel consumption will be high, efficiency will go down, etc. So it is not advisable to continue it after the ideal replacement cycle. This is calculated as an equivalent annual cost. So this is the method we are going to use to really understand what is the ideal time to replace the asset. So formula is NPV of cost over replacement cycle. You know, NPV is nothing but present value of future cash inflows minus outflow. Annuity factor, that means how many years you are using that asset. Okay. Annuity factor is taken when there are constant cash flows. Any revenue which we have already discussed in our previous sessions, what is annuity factor? Any revenue resulting from the use of asset will be disregarded, as this revenue will occur in any case. Whatever the replacement cycle and is therefore not a whatever the replacement cycle and is therefore not a relevant cash flow. So any revenue resulting from the use of asset, because we here take only cash inflows, not the revenue. Okay. So any revenue resulting from use of the asset will be disregarded, not considered, as this revenue will occur in any case, whether you are having this asset or not. You will be having a new asset. Whatsoever it is, you are going to generate revenue. That is irrelevant here. Whatever the replacement cycle, and therefore not a relevant cash flow. That means they are saying whether you're going to look, whether you're going to replace in 3 years, whether you're going to replace in 5 years, whether you're going to replace in 10 years, doesn't matter. Revenue is going to be generated every year. Okay, because it's a going concern business. You are not going to compromise with revenue anyways. You're going to continue generating that. Because in 3 years you replace, you immediately bring a new asset, again you continue. So revenue is however going to be earned. So that's the reason why it is not a relevant cash flow. Okay. Why it is irrelevant? Because irrespective of replacing any time, the revenue has to be earned for business to continue or for business to survive. Equivalent annual cost, express the present value of the cost of an asset replacement cycle as cost per year. That means whatever the asset's present value is as on today, which you want to replace, you are going to take a cycle like 1 year or 2 year or 3 year. Every 1 year you want to replace, every 2 years you want to replace, every 3 years you want to replace, let's say. So equivalent annual cost is nothing but, let's say I have 10,000. Okay. So express the present value of cost of an asset. So this is the present value of cost of an asset. Replacement cycle as cost per year. So every year I will consider this as annual costs, equivalent annual cost. Okay. I will show you the example. So 1 year, 2 year, 3 year. These are my replacement cycles. So every year's cost is the equivalent annual cost. How a company, so every year's like first year's cost, second year's cost, third year's cost is that year's equivalent annual cost. See, equivalent annual cost expresses present value of cost of an asset, replacement cycle as cost per year. That means whichever asset we want to replace, its present value, like cost of that asset, we are going to consider. I am going to show an example here. Let's say the purchase cost is 25,000. This is the cost at which we purchase the asset. Irrespective of whatever the replacement cycle is, this is going to be the purchase price. Running cost every years. Resale value, if I'm going to resell in first year, I'm going to get this. Second year resale, third year resale, I'm going to get the amounts. Cost of capital is 10%. They're asking how frequently the asset should be replaced. So you see, I'm going to take, if I'm going to replace every year, every 2 years, every 3 years. So how am I going to calculate the equivalent annual cost? So present value of cost over one replacement cycle. This is the equivalent annual cost. Equivalent annual cost. This amount is to be considered for calculating the equivalent annual cost. That's what they said. Present value of cost over one replacement cycle. Equivalent annual cost expresses the present value of cost of an asset in every replacement cycle, or present value cost of an asset's replacement cycle as cost per year. So this is the cost per year for that asset, what we are taking here, 18,183. So how did we calculate? Of course, we have taken all the cash flows. This is the investment what we have done on the day one. This is the cash flows what we are incurring. What is the cash flow? We are expending running cost. This is the running cost for us. This is the resale value. It's an inflow, it's an outflow. We took inflow and outflow. We did the present value of that. This is the present value factor for 1 year at the rate of 10%. So these are the, so 25,000 into we've invested here. So discount factor will be 1 always, 0th period, 25,000. 7,500 into 0.909, 15,000 into 0.909, 13,635. Now, if we solve all this, the present value is this. So this is the investment what we have done. This is the cost what we have incurred. This is the scrap value what we have got. So present value of cost over one replacement cycle, cost of the asset over one replacement cycle. If you want to replace the asset every year, this is the present value of the cost of the asset or cost related to that asset. Okay. If you want to replace every 2 years, what is the present value of the cost of the asset in 2 years replacement cycle? Or if you replace every 2 years. So when you decided to replace every 2 years, the investment is not going to change. First year's running cost, however, you're going to incur. Second year's running cost you're going to incur, and this is the resale value in the second year. So you have to do the present value. And then we found out the total. If you want to replace every 3 years, again investment. Again, this is your running cost for second year, running cost for third year, replacement value. This is your scrap value, sorry. Multiply, you get the present values. Now, this is again your present value of the asset which you want to replace every 3 years. Okay. So what are you seeing here? As you're taking second or third year, you are taking cumulatively the running cost of, if you are considering to replace your asset every 2 years, you have to take the running cost cumulatively. That means if it's going to continue for 2 years, first year's running cost and second year's running cost is also be incurred. 3 years, every year's running cost is incurred. After getting all this, we are going to divide this with their annuity factors. Annuity factor for the first year is 0.909. Second year is annuity factor is sum of present value factors. So 2 years annuity factor will be addition of these two. 3 years will be 3 years annuity factor addition of these three. You're going to divide with your equivalent annual, you are going to divide with your present value of the cost of the asset in every replacement cycle. So this is the present value of the cost of the asset in first replacement cycle divided by the annuity factor. Present value of the cost of the asset in the in second replacement cycle, or every 2 years if you want to replace your asset, this is the present value of cost of that asset divided by its annuity factor for 2 years, and this is for the third year. Here you see this is the least cost you are incurring. So you can replace your asset every 3 years. The optimum replacement policy is one with lowest equivalent annual cost. Here, this is every 3 years. So why you need to take this? See, this is the cost at which the asset is going to have the least cost. Asset is going to have the least cost. Beyond this, if you continue the asset, the cost is going to increase for the asset, and you don't want the cost to be high. You always want the least cost. You don't want the cost to be high. If you replace every 1 year, it's going to cost you more. Yes. Here you are not able to take the maximum benefit from the assets usage. With the passage of time, with your experience, with usage, with everything, your operating costs are going to reduce. In 2 years, if you replace, it's costing you more. In 3 years, if you replace, it's costing you the least. But if you continue, if you replace every 4 years, maybe the cost may increase. So this is the ideal replacement cycle. So every 3 years. Decision rule. If the you have to check which year has the least equivalent annual cost. Here, every 3 years, if we replace the asset in 3 years, then we are going to incur the least cost. So this is the ideal replacement cycle. Please have a look to this question, and you have to solve the activity one as a homework. I'm showing you. Please have a look to this. Read out the question first. Once again. Fine, let's move forward. Assets with different useful life. The same technique is also useful for deciding whether, when considering non-current assets that are in continual use within a business, it is better to invest in a cheaper asset with a shorter expected life or more expensive asset with a longer expected life. So same technique you can use for deciding whether, when considering non-current assets that are in continual use within a business. So what is this technique going to be useful in what kind of decision making? It is better to invest in a cheaper asset with shorter expected life. Let's say the asset is of 1 lakh, has 3 years life, it's cheaper one, or 5 lakh rupees worth of asset, okay, with the life of 5 years. Which one you need to pick up? Which one will be better for you? Again, the ideal replacement cycle will minimize the cost per year over the replacement cycle. That is the equivalent annual cost. That means if you want to, the same technique is also useful for deciding whether, when considering non-current assets that are in continual use within a business, it is better to invest in cheaper asset or costlier asset with more time, or cheaper asset with less time. If you want to continue that in the business, that means continuously you want that kind of asset in your business. The replacement cycle is again the lowest, uh, like minimum, equivalent annual cost. The drawback, this approach only focuses on cost and fails to recognize that an asset gets older, there could be problems with reliability or quality. See, this method is only looking at the money aspect, but not the quality aspect, reliability aspect. Okay, that is again a drawback. Now, equivalent annual benefit expresses the NPV from a project as an annuity. That's a constant cash flow per year. Now, what is this? Let's see the example. Project A has NPV of this much and expected life of 6 years. Given a discount rate of 12%, annuity factor for 6 years at 12% is 4.111. So the project A will have an equivalent annual annuity. So you need to take the NPV divided by the annuity factor. So cost is this. Equivalent annual, equivalent annual amount, we can say. Amount, let's say, because it's not a negative amount. Okay. Whereas here we saw negative amounts, costs. Okay. There it is annual amount, not cost, not negative. An alternative project B with an NPV of 8.90 and expected life of 7 years will have the equivalent annual annuity amount of, take the NPV divided by the annuity factor at the rate of 12% for 7 years. Factor is 4.564, 1.95. Project A will therefore be ranked because the annuity inflow, I can say the annuity positive amount is 2 for A, for B the annuity inflow amount is 1.95 or positive amount is 1.95. This particular project is going to give you more annuity. So project A would be ranked higher than B despite having lower NPV. I know A's NPV was 8.22, B's NPV was 8.90, but still A will be considered because equivalent annual benefit is more in this case. Okay. This method is useful way of comparing projects with unequal lives. Why? Here it was 6 years and here the project B is 7 years. Please have a look to this. We'll move forward. Okay. Drawbacks. This approach only makes sense if projects are being continually renewed. That means you again want to change something in the project. This assumption of continually replacement was also used in EAC approach. That means you are continuously seeing here like which project you will be taking up. You will be taking up project A because the benefit is high, right? You have to do this continuously. That means more often, 1 year or 2 years. It is not the case, then the project with highest NPV would be chosen. If you are not continually renewing the project, then of course the natural rule is project with highest NPV should be taken. But if you are using this equivalent annual or equivalent annuity approach, then you have to continuously, uh, review the projects or the projects which are to be renewed every 1 or 2 years. For that, this particular methodology is applicable. See, we have just 2 minutes, and I want to start a fresh topic: lease versus buy. So what I'm saying is tomorrow I'll wind up lease versus buy as well, and also the last one, capital rationing. Both the topics will be done by tomorrow. So this is the last class tomorrow for NPV IRR. Okay. Thank you all of you.